we continue to see investors now losing appetite for risk. How important is it that you have a defensive approach to investing, and how would you go about doing that?
Well, we think that there's a lot of demand for income in the world, but we're taking a cautious stance. The positive is that you are seeing global economies gradually reopen and recover, but we have a long way to go. In the United States alone, we've got 20 million jobs we need to get back, and we still see a very high single-digit unemployment rate even by the end of the year. So while a lot of this mobility continues to slowly improve, it's improving off a very low base. And the one thing we would say, though, is that the Fed is really providing a lot of liquidity, and these higher quality companies, particularly in the United States, like utilities, telecom, cable, towers, healthcare, pharmaceutical, they have very strong balance sheets. So there are a lot of risks out there, like a second wave of the virus reemerging. But the higher quality companies do have the ability to get through this. And so that's why we want to take a more cautious approach.
We continue to see the numbers of U.S. businesses adding to debt. For example, today we saw non-financial companies' debt soaring by almost 20% in the first quarter, a record high. Are there any concerns here that potentially all of this easy money could really lead to, again, more bubbles and not enough deleveraging and potential defaults?
Certainly in some of these more cyclical companies, particularly those that are higher levered to begin with, we are expecting downgrades to continue. For example, in sectors like energy and autos and retailers and chemicals, those companies really had headwinds even before we started this crisis. But if you look at a lot of these U.S. investment-grade companies, particularly in these more non-cyclical areas, the balance sheets are relatively unlevered, particularly in areas like cable, telecom, healthcare, pharmaceutical, technology companies. So really, it's a bottom-up story, and you have to kind of do the work on the ground. But overall, we do want to favor the U.S. because of the power of the policy response by the Fed and the governments, and we want to favor the stronger, higher quality companies.
So, Mark, obviously with the greater liquidity, Fed support, that should lower the numbers of defaults that we see. Are you worried about moral hazard at all in a market like this?
Well, I think, there is a lot of credit risk out there. The point that the debt has gone higher, the recovery is going to be fragile. These social distancing policies may be in place for longer. So it really is a situation where buyers need to be cautious. They need to do their bottom-up credit work. And that's why a lot of these companies that are exposed to travel and tourism do have risks. Investing is not without risk, and so buyers should beware and do the research in terms of which types of companies they're going to invest in.
Mark, I want to just draw your attention to a conversation that we had with Steve Major from HSBC, talking about essentially with the Fed freezing rates where they are going into next year and potentially the year after that. We are kind of presented with a different set of investment, levels and strategies. Just take a listen.
The reference to keeping rates where they are through 2022, what that means is a sort of date-dependent forward guidance. That means that 5-year bonds, fives become the new twos, because they've just locked down the 2-year. The 2-year is going nowhere because the 2-year is linked to money, and they've just confirmed that. So you might as well buy the 5-year, because in 2 years' time, it's a 3-year piece of paper.
So, Mark, do you agree with that in the sense that with what we know about forward guidance from the Fed, we now need to kind of reassess what we look at as investment opportunities and strategies according to tenor?
Well, I think there's no question that the Fed has no plans to raise rates in the next 2 years, and that's just a function of very high unemployment. We think the unemployment rate, even by the end of this year, will be around 8 or 9%. And inflation being below target. We think it's going to take at least until 2022, if not 2023, before we get inflation at 2%. So this means, yes, the Fed is not going to be raising rates in most scenarios, but it also means that investors around the world facing very low yields on treasuries and very low yields on government bonds in Europe and Japan will also want to earn income. And what's interesting about the U.S. investment-grade corporate bond market is the hedging costs have collapsed. And so investors in Japan and Europe can actually buy U.S. investment-grade corporate bonds and hedge the currency risk and earn yields now that they haven't seen in 4 or 5 years. So the investment-grade corporate bond market will likely be supported, and that's really the conclusion from the Fed being on hold for a long time. The Fed has also put in an important backstop for corporate bonds. In fact, they've bought so far in the last 4 or 5 weeks $5.5 billion. So we do think that as long as you do your homework and stay high quality, that investment-grade corporate bonds will be supported in this environment.
Mark, just quickly before we let you go, what are you making of China's bond markets? Because we continue to see now the slowdown in new bond issuance, and people seem to be concerned that the easing with the PBOC is not as big as everywhere else.
Well, we think that China is going to have to do more, and we do think that interest rates will likely come down in China as well. Their market is struggling just like the United States. They're going to need to ease financial conditions, and that their economic growth is way below target. In fact, they even abandoned growth targets. So the reality is that you're going to see much more monetary policy support globally in China, in the United States, more willingness to use fiscal policy, particularly in the United States, but also in China. And so this low yield, low inflation environment and relatively low growth is going to be continuing globally. And that's why you want to stay defensive. You don't want to be taking high risk investments in companies that are highly levered. But these companies globally that have strong balance sheets, those equities and bonds will likely be supported.